let's talk about Trump's pick to lead CMS, Medicare, Dr. Oz. You ever watch Dr. Oz on TV, David? I've only ever seen clips.
No, I think like maybe occasionally. You ever get sick and you watch daytime TV and you're like, I'm glad I have a job. Like if you're sick at home and you watch daytime TV, and yeah, so I probably have watched Dr. Oz, but and all it did was make me want to go back to work.
It made you want to go back to work. Yeah, I'm not a Dr. Oz fan. I never really watched him. I always felt that a lot of, well, I don't want to piss off any Dr. Oz fans or anything like that, but
that'll be the next reviews.
Yeah, let's just, you know what? Let's skip the unfounded opinion and just get to this issue here. According to recent reports, Dr. Mehmet Oz, President Trump's nominee to lead the Centers for Medicare and Medicaid Services, also known as CMS, paid no Social Security or Medicare taxes in 2023 and only negligible amounts in 2022. The guy
no Social Security either?
No. The guy picked to lead Medicare paid no Social Security or Medicare in 2022. Well, a little bit in 2022, nothing in 2023. This tax strategy, which we will talk about, has drawn scrutiny from Democratic staff on the Senate Finance Committee as Dr. Oz faces confirmation hearings. At the center of the controversy is a tax strategy. Dr. Oz used what is known as the limited partner exemption to self-employment taxes.
Oh, I saw this on TikTok. Yeah, I could do this.
Oh, that you can do this?
It's a TikTok strategy. I don't know if it is.
Do you want to explain it?
I never saw it. I just made that up. I don't know if it's on TikTok or not.
I wouldn't.
It sounds like it should be. It sounds like it should be.
Maybe we should go make a TikTok about this after and see how, maybe we can just quit the podcast. We'll just become TikTokers. So let's do a brief review of self-employment taxes, David. They are imposed under the Self-Employment Contributions Act. Self-employed individuals must contribute to Social Security and Medicare. So you don't have a traditional employer, you're self-employed, still got to pay into Social Security and Medicare. And it's 15.3%. It's assessed on your wages as self-employed. And it's two components, 12.4% Social Security applied to the first $168,600 of income tax of income in 2024. And the Medicare tax ranges from 2.9% to 3.8% based on income levels. And that has no cap. So for a very high earning individual, the Medicare tax can be a lot. Because if you make $1 million,
it doesn't stop. It just keeps going. Yep.
It's on all $1 million. So trying to get out of that, trying not to pay that is, if you can do that, that's a great way to minimize your taxes. And the IRC, the Internal Revenue Code, provides an exemption from self-employment tax under Section 1402A13, known as the limited partner exemption. The provision excludes the distributive share of any item of income or loss of a limited partner as such, other than guaranteed payments from net earnings from self-employment. And it was originally intended to stop people from contributing small amounts in limited partnerships and therefore gaining eligibility for Social Security benefits, but now it's used to avoid paying into Social Security and Medicare. So what you do is you classify yourself as a limited partner, and then you don't have to pay that self-employment tax on your earnings from the partnership. Now, what is a limited partner, right? It's ambiguous because the IRC and the Treasury regulations do not provide a clear definition of what a limited partner is. And this rule about limited partners, right, this law, under the IRC, it was all created before we had LLCs and LLPs that were generally created in the 90s. So Dr. Oz, the way he got out of Medicare tax is he said he was a limited partner of his limited liability company, Oz Property Holdings, LLC, which looks like it's here in Arizona. And by doing that, by classifying himself as a limited partner, he may have underpaid Social Security and Medicare taxes by approximately $440,000 over the examined period, which I guess is 2022 and 2023, it sounds like. And the committee staff, the Democrats in the Senate committee, are saying, well, you can't have been a limited partner because you were actively involved in the company. He has a TV show. He's
the brand. He's the face.
He's the brand, and he's actively the brand. And so it's ironic, right? They're highlighting the irony that here he is avoiding paying into Medicare, and he wants to run Medicare. Now, there was a recent case that is called Soroban Capital Partners LP v. Commissioner. It was decided by the tax court in November of 2023. And Soroban Capital Partners is a hedge fund organized as a Delaware limited partnership. They did not report their limited partners' distributive share allocations of income as net earnings from self-employment on partnership tax returns. And the tax court rejected the argument that a limited partner can never be subject to self-employment tax on their allocable share of partnership income. And they said that, no, there has to be a functional analysis to determine whether a limited partner is receiving its distributed share of income or loss as a limited partner. So it's how active are you in the business? But of course, the court didn't make this easy, and they didn't establish any test on what a limited partner is, whether you're actively involved in the business. So there you have that gray area that you can exploit, like Dr. Oz, to not pay Medicare taxes. Just call yourself a limited partner of your LLC. I mean, we should be doing this, David. Nobody's ever going to audit us.
And right? I'm sure he's lawyered up, and he has accountants that have given him the strategy. I don't think he came up with this on his own.
No, of course not.
He has a very good tax accountant who helped him figure this out,
right?
And told him to do this, and they probably got a piece of that action, because I think his net worth is $80 million or something. He's or maybe more than that, or yeah, it's between $100 million and $300 million is his net worth. So there's real money involved in this thing.
So what's fascinating about this is that I bet you this would never have come to light, and Dr. Oz would never have been audited and asked to pay this Medicare tax, Social Security tax, unless he had become political. That's when everybody starts to dig into your tax returns. But just think about this, right? How many people are doing this? Classifying themselves as limited partners when they're actually actively involved in the business? Probably lots, because it seems like it's a fairly easy thing to do because of the gray area involved. Back in 1997, the IRS proposed some rules, some regulations that would have formalized, the definition of a limited partner, but they never actually finalized them.
So law was X. A court ruled on it, but then it's never became codified. The legal ruling.
So the court decided against a particular taxpayer, but then never established like a test for what is an actively involved person. What is a limited partner? How active do you have to be before you're not limited anymore in all of this?
So people will either keep doing this today, or it'll be like, remember when the Clintons got in trouble for the whole nanny tax and everybody ran out and started running payroll with taxes taken out for nannies? Like maybe because of this attention this is going to get, maybe people will stop doing it.
Well, I think it's a great strategy. I mean, if Dr. Oz gets away with it, I mean, like, I would be doing this all day long, right? Like, so, but of course, it all comes down to what the court says, because there is not a hard line. There are no rules. It's up to you to document it. So it's like in my interview with Jasmine DeLucci on the Earmark podcast. Go listen to that, because she talks a lot about this. She says, to paraphrase her, it doesn't matter how clever your tax strategy is if you don't execute it properly. And executing it properly means having the paperwork, having the documentation to back it up in court. So if you're going to do something like this, make sure that you have documented, make sure that you have proof that you are a limited partner and that you are not actively involved in the business, so that you can.
And I imagine, we don't know which accountant helped them with this. I imagine this accountant's probably doing this with all their clients, which seems to me risky too, right? Like you don't want to use the same strategy with every client you have, because that'll eventually get some attention too.
Well, and this is very similar, it seems, to S-Corp compensation, single member S-Corp compensation, where there's actually a lot more guidance on that from the IRS, but it's still a matter of discretion. And there's some folks who go really aggressive with the super low salary, and there's some people who are really conservative and pay a really high salary. And there's this huge area in between. And so as a tax pro, you're getting pressured because here are these influencers on social media saying, no, you only have to pay yourself like, $30,000 a year, and the rest you can take as a distribution, right? So it's tough. I think we'd actually, in many ways, be better off as tax pros. Like most tax pros would be better off if the rules were clearer, because right now they are not. But if you are helping really high net worth individuals avoid taxes, it's actually great if you have all this ambiguity, and it's great if you don't have a lot of revenue agents going after you, because then you can really push the envelope. You can go really hard for your clients and save them a lot of money, and there's very low risk to doing it.
And the people that can afford that are going to have it's going to be higher net worth people that have more money involved. They have motivation to skirt the system a little bit and avoid this. Now, maybe if he was using a payroll system like OnPay, if you want to read the OnPay ad, Medicare would have been taken out of his paychecks properly.
Thank you, OnPay, for sponsoring this episode.